This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cashback on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Looney Hour, episode 52, the official 1-year anniversary. Thank you all for your support. 52 episodes almost in the bag here. Welcome back to the show. As always, we've got the three amigos. We've got Keith Dicker of IceCap Asset Management in his Patagucci jacket, and Rich Diaz of Acorn Macro Consulting. Welcome back to the show, gentlemen.
Thank you. We did it. We survived one whole year of lockdown. So no.
I'm sick of you guys already.
Yeah, I was going to say.
It's like the movie Step Brothers, right? You know, you love each other and hate each other and everything. Right. I have to say, like over the last year, and I think, you know, a lot of my single favorite moments was when I was telling stories and stuff, because I thought they were pretty cool. But my second favorite overall is Rich in your t-shirts. Like they're pretty epic. And I think
some of them going viral on Twitter.
I know, they're especially, my favorite one is just of Rich wearing a t-shirt of Rich. So that's pretty cool. Hey guys, I have something special for us because it is the 1-year birthday, correct?
That's right.
I don't want it. Whatever it is, I don't want it. Oh.
So for
if you're listening to the audio version of this,
yeah,
Keith
Steve,
has
you
a
describe
Twinkie.
what I have.
Keith has a Twinkie with a candle in it, and he's now lighting the candle. So we now have a Twinkie on fire.
Wait a second.
No.
It's tough to watch.
Yeah, he doesn't know how to use a match.
Let's try another one.
Child safety.
Okay,
matches.
well, while we're on this, we actually have a
fire.
Well done. Okay.
You gotta eat that thing.
Wait. Shit, I want to sing happy birthday, but I can't lift it up. It's going to break. There we go. Happy birthday, Looney Hour. Cool.
Boom.
Blow it out.
Well done.
1, 2, 3. That's cool.
Eat that thing now.
So guys, I was wait. I was in New York there once, a few years back, just off of Rockefeller Center, you know, that area. It's a place called Bill's Burger Barn. So if you like burgers, you know, and then you're in New York, go there. But one of the key things they do, what they're famous for, if it's a birthday in your, you know, in your group or party, they have this guy from the kitchen, like he's like a baritone, and he comes out with, you know, a cupcake or something with sparklers on it, and all the staff will fall onto the table, and he's going, "Happy birthday," you know, in that manner. Anyway, it's a good bit of fun. So maybe
Bill's Burgers,
Looney Hour. Yeah, burger is always good.
Bill's Burgers for the Looney Hour live event next year, 2023.
Yeah,
look at your calendar.
New York City.
Eat those burgers while you can, boys, before they get banned. So you know, enjoy them while you can.
Burgers aren't cheap these days either. With that though, with the 1-year anniversary, we have a big announcement in the Looney Hour. The Live Looney Hour event for December the 1st is officially confirmed. It will be in Toronto, and it will be, drum roll, at the Hockey Hall of Fame. So yeah, I think it's a really unique venue. Obviously, I think it kind of coincides with everything this podcast is trying to do, which is, make light and have some fun. Keep it Canadian. And so we'll be doing the live event December 1st in Toronto at the Hockey Hall of Fame. We'll have some details and tickets to be released over the next 1 to 2 weeks. You guys will be the first to hear, obviously, about the announcements. So stay tuned into the podcast for that. But we have the whole concourse actually being rented out. So you usually have to go and you have to pay an admission to walk around the concourse. So they've got like games, all the jerseys, game worn memorabilia, the Stanley Cup, everything's going to be there. We've got the entire concourse. We've rented out inside the concourse. It's called the TSN Theater. That seats about 140, 150 people. So we'll be jamming that thing to the brim. So yeah, definitely looking forward to that. And hope obviously as many of you can join and come hang out.
Cool. So one thing I'm looking forward to what having it there, I'm going to have my elbows up whenever I walk into the corner.
God.
The Looney Hour is getting sued. Lawsuits flying around left, right, and center.
I'll be looking at all the Stanley Cups the Montreal Canadiens have won, and anybody who wants to come talk hockey with me and Macro, I'll be more than happy to. It'll be really fun, man. We'll get to meet some people like we did in Vancouver, which was just amazing. Get shake some hands, kiss some babies, and so it was
drinks,
really,
and the drinks will be flowing, most importantly. So
yes, very much so. And
it's gonna be
we'll have a good chat.
It's gonna be a great time. If you guys, anyone that was there in Vancouver, we had a blast, and I think it was a great success. So looking forward to seeing you guys at the Hockey Hall of Fame, December the 1st. Stay tuned for those details. But while we're at it, I think this is a great sort of transition piece here. So I'm actually in Toronto right now. I'm actually at this Veritas housing conference. They do it every year. So I was a speaker at this event, basically just talking all about Canadian housing, which is near and dear to our hearts here. So I'll kind of give you guys a little bit of background on that. So I'll save you the $500 admission fee that they were charging everybody. But I think, to sort of bring some context to this, is we actually had an update on some housing stats in Vancouver and in Toronto for the month of September. So those have officially come out. And so Greater Vancouver home sales were down 46% year over year in September. Over the past 30 years, so I think last week I said, hey guys, it might be a 30-year low. It was like more or less within like 100 sales, it was basically a 30-year low. But so the only time we've had a slower month of September were September of 2008. Of course, you can figure out what happened that year in that month. September 2012 and September 2018. So very, very weak month for Greater Vancouver home sales. Same thing in the GTA. You had in the GTA, you had a 44% decline. It was a 20-year low for home sales in the GTA. So you got your two largest markets in Canada, basically, have almost no transactions happening right now. What is interestingly, what's happening, just to kind of expand on this, is that new listings. So, the buyers clearly don't like the prices today. So you got a buyer strike, but we actually now have a seller's strike because new listings in Greater Vancouver and in the GTA are basically at 20-year lows as well. So sellers are pulling their listings off the market and they're putting up a fight. So again, whether that's the right decision or the wrong decision, there was always this notion that, hey, we're gonna get this flood of inventory, everyone's gonna foreclose, and we're not seeing that. It's still very early, could happen, but as of right now, sellers are actually digging in their heels, and we're actually seeing prices, despite very weak sales, prices are actually firming up right now. So it's an interesting dynamic.
Keith, sorry, Steve, what percent do you think of people are negative equity, and in the height of the 2008 bubble in the US, I mean, in some jurisdictions like in Arizona or Las Vegas, I saw numbers of 40% of households were in negative equity. I know it's not going to be like that in Canada because we just have a different mortgage market, etc. But could you put a number on it if you had to guess?
I have no idea. I think like I don't know what the bank LTVs are, Keith. I think they're around like 50%. Like that's like their book, I think. So like you have to think there's like I think there's 1/3 of Canadians that have like no mortgage at all. They own their home outright. And so I think like the problem is you've had a 30-year bull market where like prices have just gone up so much. Like I think to get back to pre-pandemic prices, like you have to drop like 30% nationally just to get back to pre-pandemic levels. And right now we're down 12%. So like that gets you back to pre-pandemic. And I think many people would argue that pre-pandemic prices were actually still pretty rich.
They were. If you look at the OECD house price to income, house price to rent ratios, they were higher than if I'm not mistaken, every other OECD country. So yeah, it was still quite rich even in 2019, and then it's gone up from that.
Yeah, so let me just give you guys like a little bit of context. There was some really, really good speeches, like people from like all aspects of like the Canadian economy and housing market. So we had like, and a lot like most of these guys are on Twitter. So we had like Ron Butler, who's runs one of the largest brokerages, mortgage broker companies in Canada. We had John Love, who basically he's a billionaire. He founded Kingset Capital, and they basically like fund like massive development projects in Canada. Just so many smart people. And I think like everybody's of the view that like the bull case for Canadian housing right now is like prices go flat. Like that's the optimistic scenario, is that like we get a flat line here, and that's the optimistic scenario. The bear case is obviously a deepening depending on where interest rates go. I think that the consensus seemed to be that because new listings are basically extremely low right now, that we're actually going more into like a slow grind right now, where buyers and sellers are both like fighting each other on pricing. And so like prices are like, I think, going to trickle lower into next year. We also had, economists from CMHC there and everything. So it's really, really fascinating. One of the things that there seems to be a resounding belief in, and it was really interesting to hear, to hear John's comment, John Love at Kingset, really, really smart guy. I mean, like, again, you don't get to billionaire status, I think, without knowing a thing or two and how to operate. And his view was, if you look at Canada's recent immigration stats, which I think we touched on last episode, 55-year high, 700,000 new people year over year. What's happening now is that housing projects are being shelved rather aggressively, in Kingset, which funds a lot of these new construction projects, said like, yep, people we're canceling, or like we're more conservative on our debt. So like these and so the presentation that CMHC gave at this meeting was, we need to build, I think it was like 3 million new homes by 2030, which is like never going to happen. And now you're seeing housing starts like roll over. So the view is basically the next like 12 to 24 months are going to be challenging for Canadian housing. But if you're looking like 5 years out, like the population immigration story hasn't changed. And the fact that governments around the approval of new housing, it's so bureaucratic. You have so much NIMBYism. It's impossible to get things built because of all the levels of government, that you're just never going to, I think, have an overabundance of housing.
There's a floor. There's a floor
There's
at all these prices.
Yeah. And people don't like to hear that, but I mean, it's just like, that's kind of the reality. I said, yeah, I think like prices will go down here in the short to near term. But I think structurally, policymakers are slow to react. The system is so bureaucratic. It's impossible to change.
Just I have a question for you, Steve, as well as a comment as well. So first of all, the comment, from a capitalistic perspective, or from capitalism, whatever the right word is, if I want to allocate my capital to the real estate market right now, I want to make sure I'm going to get there's a required return that I want as an investor. Now, I don't mean I'm going to buy a house and flip it or something. If I'm a developer and stuff like that, And so I'm sitting on my capital and I'm looking around and I'm seeing, oh, wow, like things are pretty bearish and stuff like that. I'm going to be a bit hesitant to allocate my capital to that opportunity. And I suspect that's what's happening right across not only the country right now, but in other markets as well. Because remember, like the private sector money is very different than government money. Government money does not run on a profit and loss. It's, for the good of society and all that stuff. But as a developer, I'm thinking, okay, I'm not going to invest my money in this if I'm going to lose on it. So I think we will have that struggle coming up. The question I have for you is, because you're at that conference and you know that industry so much better than I do. Give me the knock-on effects of a bear market in housing. Starting with the realtors at the top, of course, and then going down to mortgage brokers and like who else is involved in the chain, the food chain, and what do you think they're seeing these days? Sort of just share that perspective for everyone.
Yeah, it's a good question because we really have like a whole array of industry specialists in different areas that can, they all intersect, right? So, top down from obviously the realtors are going hungry these days. But, it starts to run into like the house in Canada, like again, right or wrong, it is what it is. The house has been used as an ATM machine, particularly over the last 10, 15 years, right? So anytime, we always talk about Canadian household debt levels and, oh my gosh, everybody's so indebted. But like, as long as your house goes up, you can just keep refinancing and especially when interest rates keep going lower and lower, right? You just keep every couple of years, you refinance, you take out a bit of equity, you pay down your high interest level debt, whatever. Hey, even if values go up a lot, you can always just you can always just sell because you can't afford it anymore. You can sell, pay off some of your debt and downsize or whatever. So I feel like sort of it's kind of the old analogy that a rolling loan carries no loss, right? And so now we're entering a situation where, house prices are dropping, and not only that, but interest rates are going up. So like it's kind of like the people that sort of could extend and pretend are now going to face that difficult scenario. And so this is going to play into, fewer home renovations, buying your car on a home equity line of credit, or because you have to think about it, right? It's like your variable, if you floated a variable rate mortgage this year, you're up about 300 basis points year to date. So as we talked about, $1 million mortgage, it's $1,500 a month, roughly. People will just cut everywhere else. And so that's really what you're going to see is just economy wide. I think you're going to see that this is going to have impacts, but it takes time. It's so long and drawn out.
Are you seeing evidence from the banks right now that they're being more restrictive with lending, or is it business as usual?
Yeah, we had one of the big banks actually come out this week that's going to be changing some internal policy. It's obviously not publicly announced, but one of the big banks will be tightening credit, lowering sort of their total, TDS ratios on what you can borrow. Private lenders are tightening up too, right? So if you're a private lender, they're dropping their loan to values and how much they want to lend. So it all has these knock-on effects, right? We haven't faced these levels of mortgage rates in 14 years, right? So I think it's going to be painful. And interestingly enough, we actually had some comments from Tiff Macklem today, which I'd love to sort of get into, right? Because everybody's, myself included, I've been first to admit that, the interest rate call at the beginning of the year was dead wrong. But you sort of adjust and pivot with the information that comes in hand. And there doesn't seem to be any pivot coming. And the more, let's put it this way, the more resilient that Canadian housing continues to be, I don't know if I'd say it's been resilient, but like the fact that it's like, okay, prices are sort of firming up a bit, the more resilient that it is, the more ammo it gives for the Bank of Canada to keep hiking rates. So they go, hey, look, we still haven't broken anything. People still don't believe us that rates are going up. Because like I said, sellers are pulling their listings off the market. And and we got a 20-year low in new listings because every seller believes that at this time it will be short term. Any correction in Canadian housing is always short term. I'll wait till next spring. And like, what if next spring is worse?
So what was really interesting today? So one of our Looney Hour friends, Peter Kay in Toronto.
He was at the event.
Peter.
God bless Peter.
Okay, yeah. And but Peter tweeted out the story, and it was something that we were noticing even before the article came out. So so today is Thursday here, and when we look at markets today, I mean, is it from a currency perspective? Euro, CAD, Aussie, Rand, pound, Kiwi, like everything is down between 1.5%. In the yen is down as well dramatically, which I want to touch on. But the big thing with Canadian dollar, so on a day when oil continues to scream higher, and the Bank of Canada comes out and they're screaming that they're going to raise rates higher, yet the Canadian dollar is weaker. And so maybe the pivot isn't necessarily, this is for Canadians from a currency perspective, maybe the pivot that you shouldn't be looking for is, when do central banks actually stop raising rates? And by the way, the Aussies did pivot this week. They only raised by 1/4 point. So they gave in, right? Because their housing market could go kaboom, at a moment's notice.
Yeah,
but,
it's about variable interest rates.
Yeah. They're pretty good.
Are they heavy variable in Australia?
Very, very heavier, much heavier than Canada. Anyways,
it's similar to UK though, isn't it, Rich? Like in the variable.
Yeah,
exposure?
I have it's somewhere in one of my emails. I have a chart that like lines out for every country. And you've got like the US at one end of the spectrum where it's all fixed and it's all extremely long duration. And then you've got on the other end, it's Australia, which is extremely short duration. It's all fixed, but for 1 year or 2 years, which is sort of a contradiction in terms.
Yeah, one of my good friends, he's a portfolio manager over down there, I guess. Michael Schneider. You ever come across? He's hard to find his work. He's a bit obscure. I know he's not watching this because
obscure is usually good in this business. In this business, obscure is good.
Yeah, he's cool, so he doesn't watch the Looney Hour.
Yeah.
Unlike Peter Kay. But back to the so-called another perspective on the pivot. We mentioned before, Canadian dollar has been performing really well on a relative basis. It's down versus the dollar, but it's done really well versus like yen, euro, and stuff like that. And, as has, Brazil real and peso. Maybe the pivot, I said this last week, maybe the pivot is starting in that, you tend to sell your winners and buy the losers in any kind of market. But for the Canadian dollar to be really weak today, again, on a day when it's, oil is up, and the Bank of Canada is pointing up, like that's a bit of a sign from what we look at anyway. But it just gives us more conviction with our strategies, what we're doing.
Yeah, so we're gonna get into Canadian interest rates, oil, obviously some large developments happening there, but I'd love to quickly touch on Tiff Macklem's comments today, which the market's obviously been picking up. So he basically came out and said, quote, "Simply put, there is more to be done. We will need additional information before we consider moving to a more finely balanced decision by decision approach." So basically, he is signaling higher rates from here. Keith, do you have the market pricing as of right now for October? Like, are we pricing? What are the probabilities of 50 basis points at the moment?
Yeah, I have the pricing right in front of me. It's so from the time he spoke today to the end, basically we've had about another 1/4 point added to rate hike expectations coming up. It hasn't changed dramatically, guys, but it's changed. It's a material change in expectations. So as of right now, the next meeting is October 26th. So we're definitely getting 50. There's a small probability it could be more than that. So right now it's 50 basis points in October, another 25 or so in December. So that's a 75, but it could be 100 points because the market's a bit uncertain right now. But the market, like last week, we had the Bank of Canada's priced at around a peak of 4%. So since this morning, it's now pricing in 4.25. So again, that's a pretty.
So we have another 25 basis points for your terminal rate.
Yeah, absolutely.
Okay.
So before we go on, I just wanted to add two things, which is sort of the economic impact or the potential economic impact of the housing. And I would just say, I think we're maybe counting our chickens a little bit too early on the economic side of it, because I still don't think we've felt the full impact of the interest rate hikes at all, which compounds the mistake that I think Tiff Macklem is doing. It's, I guess, call me a hypocrite. Before I said that he was too easy, and now I think he's being too tight. Because haven't you told us that, lots of these mortgages are variable, but a whole other chunk, like 55% of the recent issuances or whatever it is variable, but the whole other chunk is very, very short. Like, again, the misnomer of the fixed rate for 2 years or fixed rate for 3 years. And we're about to enter in that whole, what do you call it? You roll over that debt, you refinance, or you go to the bank and you say, well, I used to pay a mortgage of 1% or 2 or 5 or 3 or whatever it is. And now it's going to be what, 6, 7. And I think we're only just starting to get into that. Compound and add that to the fact that we think that there's weakness in some of the sectors in Canada outside of the real estate. And then we talked about weaker employment. We've also talked about real wages in Canada that are not at all keeping up with wages in Canada are not at all keeping up with inflation, unlike in the United States, where you have real wage growth is actually 1 or 2% or even higher in some cases. In Canada, that's not at all the case. And so I just think, I think we should, this has still got a couple of innings to play out, specifically with the impact of the delayed interest rate hike. And the other thing I would say is last week we talked about the GDP and the components of GDP. We talked about consumption, government. There's an inventory component. There's a net export component, and one of them is investment. And Canada does not invest in. We know it doesn't invest in research and development or intellectual property. And what it has been investing in is in real estate and residential. And it's an incredible amount. I think it's like 38 or 40%, which is very, very high relative to other countries. And if that number starts to decrease, it'll pull on that component, pull down on that component of, the GDP equation, and make it very, very hard for GDP growth to just purely looking at that kind of identity and where you can see weakness. And so, that's sort of, unfortunately, that's like a vicious circle, right? You get less employment, people spending less because they feel less confident, they have less access to credit, and then they feel less confident, and there's less spending in that sector, and then GDP starts to get lower, and et cetera, et cetera. And so I think the pain on the housing, just from a purely economic standpoint, forget the pricing, I think is still a ways away.
Yeah, I mean, I would agree with that. It's all like slow moving. So, yeah, saying at this conference we had Scott Theriault, who's pretty active on Twitter there. He does consumer proposals and bankruptcies, right? So yeah, he was just saying like these people aren't typically proactive, right? So they're not like, oh my gosh, I got all this debt, like I'm a little bit like, he's like, they only come in to start like talking about like filing bankruptcy and consumer proposals like once they start missing payments, right? So he's like, what's happening now is like people are kind of like, they're stretched, they're like they're barely making ends meet. You're scraping everything you can to sort of maintain your mortgage, right? I mean, at the end of the day, like you can't live on the streets. I mean, you need a house to put a roof over your head, especially during the Canadian winters here, right? So you just cut everything else out, and so it's going to take time. Richie, as you mentioned, I think it's something like close to 20% of all mortgages turn over in Canada every year.
Wow.
Right. So, because it's
cool.
Typically your 5-year mortgage, it's turning
Right.
over about 20%
Sorry.
of 20% of your portfolio. But you have to consider like of that, like there's a portion that's floating rate variable. So like, yeah, these things will take time to play out. You've also got your private market, you've got your alternative market, which tends to be 1-year bullet loans, right? So you got a 1-year bullet loan last year at 4% or 4 to 5, depending on the lender. And now you're renewing at 7 and 8. So those are the circumstances that it will take time. And it's funny because the Bank of Canada's own data, doesn't it say like it takes like minimum 6 months for like interest rate hikes to like filter through? So like,
and that's the kind of a bogus number as well. But anyway, that's a conversation for a different day.
I mean, I think anyone can like look out onto the streets in their day-to-day life and say things are slowing down.
But this is
policymakers aren't proactive. So
I was just going to say, this is the problem. One of the charts that, got a lot of traction several months ago was the residential investment. So gross fixed capital formation. Remember that I component in the GDP identity is that residential investment as a percentage of GDP. And Canada had peaked at like 11 or 10.8 or whatever it was. And just to compare, like I compared it to housing bubbles. We know ex post for sure it was a housing bubble. Again, we don't know if Canada's a housing bubble. We'll find out in a couple of years.
You'll find out in the YouTube comments.
That's right. But in 2008, the US peaked at like 7% of GDP, and Ireland and Spain, which we know for a fact were housing bubbles, they peaked around the 12s. And I think Ireland got up to 13 or 14. I can't remember now off the top of my head. What I'm saying is when that starts to mean revert, and they always mean revert, you cannot escape it. It's so Canada, I just don't believe, even though we have an incredible amount of population growth, yada, 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 I just don't think you can't escape that gravitational pull. And that's what happens when people plow into a non-productive asset. I mean, sorry, Steve, just to call housing a non-productive asset, but anyways,
it is what it is. Someone's got to sell the immigrants the new homes.
That's right.
So something, sort of ties in with this conversation and what you mentioned as well, Rich, with growth around the world. Let's start with the growth data first. It's always been our view that the U.S. will be the big boy, the strongest growing economy on an absolute and relative basis, and that seems to be the case right now because the U.S. numbers they're pretty strong. And it's kind of ironic here because, the Americans had their ISM number this week. So that's the Institute for Supply Management. And it's a diffusion index. Rich, do you want to describe what a diffusion index is?
No, I'm not allowed. I'm not allowed to describe that.
Anyway, this index, the number that came out, it was just a smidgen better than what was expected, but it was a strong number. So again, it implies that America.
What was the reading? I actually don't know if I caught that.
It was 56.7 versus a 56.
It was a non-manufacturing.
Yeah, so it's a pretty good number. So the irony here, of course, is that the markets sell off. So good news is bad news sometimes. The investment world, sometimes bad news is great for the investment world. But so here's the irony here. So the Americans they're still producing pretty good data. This morning we had the weekly unemployment claims, and again, they were okay. They were fine. The first Friday of every month, you get the monthly non-farm payrolls coming out. And so, that's the next biggest number. We'll see how that's moving. And but the point, though, is that, as Rich has pointed out before, the U.S. looks okay right now. It's not awesome because once you dig into it, like services are doing well, but goods is struggling. We talked about before how we suspect a lot of retailers will have bloated inventories going into
Nike got slammed. Nike's earnings got slammed because they had a huge inventory build. Anyway, keep going.
Yeah, that's not because of Junior. Junior loves buying the Nikes.
Yeah, and then you had Apple, which came out and said that they are shelving some of their new iPhone production.
Yeah, so we have that happening, but yet elsewhere around the world, and again, we've always suspected that we're going to have to see September data. September data is when we'll really start to see softness showing up around the world. And so even like the global PMI number, which is the Purchasing Managers Index, which is a good, barometer for what's happening. On a global basis, we'd have had 2 months in a row where it's declining. So we're as we get September data coming in from everywhere, Like even in Germany, like the German PMIs came out yesterday or yesterday, Rich. I don't remember which day
It
it
was
was.
yesterday.
Yeah, like it's kind of softish stuff, right? And
Soft.
so
Germany's data is horrible.
I'm just being nice
Sorry.
about it.
You're being
I'm
nice. Okay, sorry.
Well, I'm normally, I'm very,
Anti-European.
realistic. No, I'm just realistic about the economic fantasy land called Europe. That's a bingo
Drink.
as well, isn't it? You
Yeah,
get that one,
yeah.
right? But Rich is right. Like it's pretty bad. So, but what this continues to do from an investment perspective, I know a lot of people listen to the show is kind of trying to put the puzzle together. This all and on top of this, it gives the Fed ammunition to continue being hawkish. Just saying, hey, we're not cutting rates, just as the Canadians did today as well. But it continues to point to a market where the US dollar, it's now getting to a point where it's dangerous. And it's dangerous because, for example, this week, India came out and they said, hey, we're going to defend the rupee. So now you have the Indians are doing FX controls in some ways. The Koreans are doing it. I'm watching Japanese yen right now, and my God, if the BOJ or Finman, whoever's doing it, it doesn't matter. If they were to stop defending the yen, it would be a 10% snap immediately, which of course would break China at the same time. So you have all this stuff happening, and it's just outstanding, right? Again, I like to say if you're an investment manager and you're not excited, like this is like the Olympics right now, or the 7th game of the the Stanley Cup Finals or something like this. This is it, guys. It's all happening at the same time, and we continue to put all these dots together. They're all connecting along the way. So, but again, like today with Canadians being hawkish, and by the way, I think the Bank of Canada is coming to Halifax very soon.
I missed them.
I'm hoping to get an invitation.
Are you going to go chirp that guy again?
I suspect I will be disinvited. It was just a guy. That's all.
Okay, we're not dropping names.
But wait, Keith, there's another angle to this, though. So I was in my client meeting today, and I went through sort of my weekly stuff. And I guess the thing is the problem why I'm not as bearish as I might have been on risk assets. I'm not as bearish as I might have been a couple of months ago. And I think it's probably a function of because, like, yes, everything that you said, I agree. And there's obviously room and scope for things to get worse. I get it. And the dollar's clearly putting on the squeeze. And we haven't even seen the Chinese get into the currency war stuff. And as we've discussed here before, the yuan is pegged and way, way, way too strong for an economy that insists on doing stupid COVID zero. But the sentiment indicators across the board are really, really bad already. And if you look at technicals, whether it's, the relative strength index, whether it's year-on-year growth stuff, whether you look at, so that's already terrible. And then valuations. So you've got a situation where, like, yes, there's the Fed, which is, a negative. And then you've got sentiment, which is, so when sentiment is really, really bad, there's a floor to it. Things are so shit that you only can go up. It's the same with technicals. And
it's so bad. It's so bad. It's good. Right. That's
right.
Yeah.
And then similarly, and valuations are very, very, very low, again, they can only go up. Then just for people who aren't maybe as well versed as you guys are with this, another way of saying it is to show like the opposite example. If everyone is super bulled up on a particular asset, Bitcoin, the only place it has to go is down. Similarly, when everyone is absolutely certain that it's crap and it's always going to and everyone is absolutely convinced and all the selling is sort of done and technicals are really, really bad and the valuations are really, really low, you could argue that maybe a lot of this negativity is already in the price. And I'm not saying that might not be true for the U.S. equity market, which is, has a cyclically adjusted P ratio of 30, or maybe it's true for some sectors, but I get the feeling that a lot of this negativity is already in the price somehow. And the more you look at, don't get me wrong, again, I don't know, I guess I'm just a little bit muddled because you have a clear negative, which is the Fed, and then all these little positive technical factors that are sort of lining up. And if you get any kind of, I don't know, reprieve from Europe on the energy stuff, or if you get China stop being stupid about the COVID stuff, I don't know. It's just, I feel like it might catch a lot of people offside if anything at all goes right over the next 6 to 12 months.
But what's great with this, Rich, is that you can structure your portfolio today so you have exposure to the fat tail event.
Right.
And in this case, is something just like,
yeah.
Does that come through?
Yeah, we heard it.
I bet you the Fonz could do a lot better
You're
job.
Such a boomer, honestly. It's so funny.
Oh, by the way, guys, Vandelay Industries, you guys did not pick up on that last week at all.
No, we didn't.
Yeah, that's what George Costanza implied he worked
that went
for.
right over our head. Anyways.
Yeah, I know. I was chuckling. But back to my cool moment here with Fonzie and I can't do that.
Yeah, we got it. We got it.
Yeah, I know. But you can structure, your investment portfolio. It doesn't always have to be all or none. So like if you're structured so that you have exposure to a fat tail event, and the fat tail event, so, everyone who likes numbers and you're in that symmetry world, you get a normal distribution chart. And, like Rich is good with this stuff, and I'm actually good with it too. I just pretend I'm not, but I am. But like at either end of your normal distribution charts, you're looking at, like the 1%, 0.5% percentile. If that event happens, you can make enough money on that end to offset or do a lot of offsets from losses, from everything else. So the fat tail event today is that, that the Japanese, they do break, or it is HSBC, which we got to comment on, by the way, in a moment, or it's UBS or Credit Suisse or Deutsche, or, you name it. But as Rich pointed out, the more than likely event is that stuff doesn't happen. And instead we figure things out. A lot of people, they're asking, hey, are the Canadian banks, are they going to go under and stuff? And I've been very adamant about it. They are not in that situation. That's, as of today, that's not the case at all. So, don't be snowballing an event out of something that hasn't happened. It could happen down the road, but that's not where we are today. And if that happens, then because sentiment is so bad, because I know we talked about a couple of weeks ago that, hey, equities could bottom soon. It could be a time within the next few months, or it could be a percentage drawdown. It could be 10%, 20%, 2%. But that's what's so great today, though, right? You can't put this stuff together. It doesn't always have to be all or none. And we're all really good, if we're a realtor or a macro economist or portfolio man, we can talk out of both sides of our mouth, right?
Definitely.
But, yeah, absolutely. What? And that's what makes us so cool. But that's the way the investment world is. I don't think you know what
that word means.
Which one?
I don't think you would think that. I don't think that word means what you think it means.
Cool. Oh, well,
yeah.
Okay. In high school, I was pretty cool.
Do you do you not think, like, do you feel the probabilities? Nothing's ever a certainty. What do you feel like the probabilities are that this ends in some sort of like financial event, like some sort of crisis and of some degree? Like, I'm not saying it's in the US, but like, I mean, there's been troubles brewing in the UK with some of these pensions, and then you've got Credit Suisse. Like, everybody's kind of like pontificating of like, oh my God, like who is it that's going to blow? But like, it's for me, you're smarter than I am, but for me, I'm pontificating. I'm trying to figure out like, the Fed getting rates to 4.5. Some people are saying 5%. Like, the Fed getting to those rates, like, do you really think you can get there peacefully? Like, I'm really struggling to see it.
So Rich will like this answer because Rich is a numbers guy, right?
Go for it.
Okay. The probability of some big event happening, I have it at 99%.
Oh my God.
I think it's happening.
That's ridiculous.
No, however, as it is happening, it could be immediately softened by policymakers. So as an example, the UK, the gilt market breaking last week, that is a financial event. Like that is an extraordinary event. And as Canadians, we have no idea how extraordinary that was or that is.
I'd probably say outside of the people listening to the Looney Hour,
Yeah.
nobody had a clue.
By the way, this past week I was chatting with someone who claims to be on the inside a lot of this stuff, and they said there's another country with a similar stress point is developing as well. So it'll be an equally as big of a name as the UK. And so if these things happen, though, again, all these guys, they chat with each other every single day. So when the UK was running the trouble, they're on the phone with the Fed, like they are. They're chatting with the Americans. They're saying, by the way, this is happening. And immediately the Americans would say, what can we do to help you? Right? Let's get this done. So, so Steve, when I say, yeah, it's 99%, something else is going to happen here, break. But it doesn't mean we go into this.
Doesn't every Fed rate tightening cycle basically end in some sort of event?
Ends in tears. Yeah. So like the greatest one, it was back in in 93, 94,
LTMC, LCM, what is it? The long-term capital markets?
Yeah, 98.
No, you guys are so young. Long-term
capital 94. Management. 98 was the Asia crisis.
Okay, kids, sit down for a second. So the 94 rate cycle, for everyone who was, actually adults back then. So that's when the Fed, it was the same thing as today. They started hiking rates aggressively. And the bond markets, went into the crapper immediately. But it created a crisis in the Mexicans were the ones to feel it. So they call it the tequila crisis back then. And then, a few years later, so the long-term capital management, it was this hedge fund down in New York, all these Nobel Prize winners, and all they were doing, they're just long Russian debt. That's all they were, and they were levered up because they were taking the spread because Russian debt paid them a great spread. They're levered up on it, and all of a sudden, Russia went into crisis. The Soviet Union went into crisis, basically, and that's why it went under. But the point is, though, as you said, Steve, like when you get this hiking cycle, and of course, the year before that was the Asian crisis. So, everything gets linked to the Fed doing something. But Rich, you made a really good point there. Not just once, you've been bringing up consistently. Normally, it's the emerging market world that leads the world into a crisis, and I've been saying that a long time. But Rich has been pointing out, and he's been absolutely correct with this. Right now, today, it's the developed world that's underperforming the emerging market world. Again, like you got the UK going under, right? So it's crazy. It's not Thailand and something like that. So it's a different game. Go ahead, Steve.
To keep on that sort of, again, Keith, you're way older than I am, so you'll have memory of
way older.
You'll have memory of every single rate hiking cycle going back, 100 years. When was the last time there was like a tightening cycle that was like that ended peacefully? Like there was like the soft landing, like they raised them and the plane landed and everybody got off.
So there
unscathed.
hasn't been one in my career. Probably so the most recent one was, I might get the years wrong a bit, but 2018. Because remember, the Fed was at zero for like 09, 08, 09, whatever it was. And then they started raising rates a quarter point every second meeting. And it just got tighter and tighter and tighter. And finally, the emerging market world, it just snapped. Because, again, something will break. But, the greatest thing about what we're experiencing today, and I say greatest because I think it gives us an opportunity to make money, is that everyone is raising rates aggressively at the same time. So it's just not the Fed. Like again, like the Canadians today, yeah, we think it's more important to get inflation down to 2%. We don't know if it will happen or how long it will take to get there. And Steve and Peter Kay in Toronto at the housing symposium, you guys got to deal with it. But again, everyone is doing it today. So
at least a crisis will help get inflation down anyways.
That's true. I just address some of the points. I think everyone's got. So I think that the bubble is in bonds and not equities. When I think we talk about financial crisis or crashes, I think that's sometimes we conflate those two things. I've been saying for a long time that the bubble is in bonds. And I still believe that's true, even though bonds are down 20% in some cases. I still think these people are not going to get their money back in real terms. It's a haircut, and it's going to be a permanent one. But I think a lot of the focus is on equities, and I think that that's a mistake and a function of our recent history. Maybe it's a function of our age. I think a lot of the investors that are in the market that on the desks today really only have 2 cycles to really look back on. And I'm going to go over those 2 cycles and why they're different than today. And it's important. The 2000 cycle was a actual equity bubble. The cyclically adjusted price earnings ratio, which is made famous by Schiller, who won a Nobel Prize in economics for some other stuff. But that was at 44 on December 1999. That is an incredible number. And so what's a cyclically adjusted P ratio? It's basically normalized earnings adjusted for inflation, and then the price you're willing to pay for those earnings. The tech sector at that time was, I think they were charging something like 70 times earnings. 70. So, I mean, just to give you, that's just an absolutely incredible number for some parts of it. I mean, overall, I think the market was, so you cannot compare the deflation the deflating of that bubble with what we're dealing with now. Incidentally, the recession was an extremely mild recession. It was actually later revised to be no recession. And just to give you, Steve, some context, the housing market in the US fell 1 month from between 1999 and like 2003. There was only 1 month of negative month-on-month growth. So even though you had a collapse in the S&P 500, I think of almost 70% or something like that, you had loads of job losses. There was, it was a deflation of a huge economic bubble. Lots of money was lost. People lost. Housing wasn't affected because there wasn't any leverage in the system. In 2008, it was the total opposite in a sense. You had very, very low price earnings ratios. I think that the cyclical adjusted price earnings ratio was something like 20. I think the PE ratio for the S&P 500 was in the low teens. There was no real dislocation on the valuation side in 2008, but you had a massive debt overhang and a huge dislocation and bubble in the housing market. That obviously, in my view, caused a depression. People will call it recession. I'll go to my grave saying it was a depression, not a recession. And to the point where real retail sales took 6 years to get back to peak in the United States, 8 years to get back to peak in Europe. Now we're in a situation where valuations are low for the equity market globally, maybe not so much in the US. And, I think that the risk is priced in. The VIX is at, 30, right? Like there's a lot of what we understand, like sentiment is terrible. All the business confidence numbers are down. There's no kind of euphoria centered on the S&P 500 being at 3,700. And the price earnings ratio has already cratered. So, when we say that there's going to be a financial accident, a crisis, spreads are already up. You know what I mean? Like there's already, it's just, I'm not exactly sure. There's a lot of focus on the equity market because I think it's what the tickers are. It's what people play. There's what's it called? There's documentaries, the GameStop documentaries like trending on Netflix, right? No one's ever going to do a documentary about the bond bubble, right? And the fact that people who invested in German 30-year bonds are down 35%, or, incredible numbers. So it's a lot less sexy. And I would submit that Keith would agree with me that it's probably far, far more important in some ways, the bond market, especially the government bond market, especially in the developed world. But I think that that's why in some ways the emerging market has escaped. They started raising rates way, way early before the Fed across the LATAM and across the Asia ex Japan. They started raising rates. Real interest rates are now positive in those countries, and their debt to GDP levels are way, 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 way lower. Whereas in the developed countries, and Europe, your debt to GDP levels are high. You've got shit demographics, you got shit productivity, and I think that that's why, although there's people want a crisis. I get it. On Twitter, everybody wants a crisis.
Give it to us. YouTube.
Give it to us. But it's like, what you need is overvaluation and overhangs, and for those to be violently exposed and deflated, and I just don't see it. Now cue the comment section to call me naive.
Yeah, you're gonna be the least favorited.
I don't know, am I totally off base? Like,
I mean, I don't know. Keith,
go for it, give it to me.
1 second. Move out of the way. Old man yells at the cloud.
Oh, he wants to agree with me. Look at that.
No, I think the challenge that the public has today, we've always grown up on the stock market.
Yeah.
So no one, you're not taught about the bond market because, it's boring, right? It's not exciting or anything. But everyone should understand that if we do get a crisis in the bond market, you get permanent losses experience, it automatically will create, this deflationary collapse. Like you'll be begging for inflation in that environment. And the reason that happens is because pension funds are stuffed with bonds. That's the way they are. Banks, regulatory capital for banks, it's all bonds. Insurance companies, it's about 40% in bonds. So if bond markets do experience this severe crisis or moment, it means you get permanent losses in these big larger funds. So example, if pension funds experience a huge loss, guess what? Your pension ain't going to be as big as what you were promised. And you can scream at the clouds or yell at the clouds all you want, but it ain't coming back. But it's a real difficult environment, and that's why policymakers will always bail out the bond market. So like you take Japan as an example, or you take the Brits from last week. Again, I keep talking about Japan today because I think, man, it's a dream. You're every peg in the world, every financial peg, it always breaks eventually. Some can last a long time, others not so long, but they always break. So right now, though, the Japanese are pegging the bond market and the currency market at the same time. And again, once something dramatic does happen with the Japanese market, you're going to go back and say, "Oh yeah, why didn't we see that?"
It's the impossible trinity. It's called the impossible trinity for a reason. It's impossible.
Anyway, I can't wait to see you. Yeah, the Hockey Hall of Fame. That's a great line. We
need to get some shirts drawn up. The Impossible Trinity.
We'll bring it. We can. There's lots of them on the internet.
There's three of us.
Anyway, sorry, Keith.
There's three. No, but it's again, if the point is that if it is the bond market where the crisis is, because there's always residual value in the stock market, and whereas I was pretty bearish on the stock market there a while back, and I've become less bearish. I think we are getting to that point where, there's not a lot of downside left on it. But the bond.
Wow, you and Rich, you guys are both going to get roasted in the YouTube comments.
Yeah, I said this a week or 2 weeks ago, right?
Yeah,
I didn't say, "Hey,
I'm just bugging you. I'm just bugging you."
Yeah,
YouTube
I didn't say it's
YouTube is always
bottom,
waiting for the
right?
world to end.
Yeah, it's all great. But you're never going to call it the top or bottom in anything, but it's, we're getting closer to it. And I'm telling you, through the moment that one of the key central banks, which would be the Fed, really, once they do this pivot, and it will happen, guys, it's going to happen, and people might think, oh, it's going to take forever, but when it does happen, boy, oh boy, it's risk on is going to go to the moon. So that's why with the investment portfolio, you'd never be all out of equities, and you should never be all in equities, right? It's just, you're just playing beta on the market. But there will come a time soon. This will turn around. However, because we talk out of both sides of our mouths, let's not underestimate the opportunity, for someone like Japan or the Chinese or someone like that to break here. And if that would happen, so for example, if the Japanese yen broke, right, they just decided, for example, today, this is the lowest it's been since they said we're going to defend the currency. and it's a big deal. Like they spent, zillions of yen today, doing this. Just say they stop defending yen tomorrow, like it would literally drop 10% immediately.
So
And then that creates, like, Canadian dollar will be down 4 or 5% on the day. Like,
do they have to sell off? This may be a dumb. Do they have to sell off U.S. Treasuries in order to defend that?
Yeah. So what they're doing, they're selling dollars, so that
Right.
nobody holds dollars, right? They all hold a U.S. dollar asset, and so
the
they'll be
Japanese have a
holding.
lot of assets. Yeah, sorry.
Yeah, correct. And like we talked about the Chinese before, they have 3 trillion in reserves, but there's only 1 trillion that's liquid. Like that's in their treasury holdings. The other 2 trillion, they can't sell it. Like it's in real estate, it's investments in this and that, and whatever. But so for the Japanese, though, one of the reasons, that the U.S. Treasury market's under pressure right now, because you have the Chinese are selling treasuries and the Japanese are selling treasuries, the 2 biggest holders. So the Japanese are the biggest foreign holder. You look at the tick data, the treasury. It's something like that. It is
the acronyms, man. There's too many
Right.
acronyms.
So you've got these massive nations
tick data.
selling U.S. Treasuries. I mean, yields up.
Yeah. So they sell their treasury, right? And then they get U.S. dollars for it, and then they sell the U.S. dollars to buy yen to try to support the yen.
No, I'm just trying to make that connection back on U.S. bond yields, basically.
Yeah. So you have that happening on a day like today. So the Chinese are doing it. The Hong Kong Monetary Authority are doing it like at insane levels right now. Like the Japanese are doing it. The Koreans are doing it. And yet here's the day, so no one, like seemingly, and again, this sounds so simple and stupid, but we don't realize it. Even though these guys are selling dollars, guess what? There's somebody else buying it, right? And so the dollar is still surging higher here, and but I think that's why you can tell I'm pretty excited today, because it is one of these moments that the young guys will be writing books about and singing songs around the campfire, stuff like that.
Keith's excited. We're excited. Hockey Hall of Fame, December the 1st. It's a great place to wrap it up. Again, we'll have more information in the next 1 to 2 weeks in terms of ticket sales. Those will be released in the next 1 to 2 weeks. So yeah, if you're looking for a ticket, you'll hear about it first on this announcement or on our Twitter feeds. So those will be going out. We're still working on some of the details on pricing and whatnot, but it will be friendly. I think, you're getting admission to the Hockey Hall of Fame and, free a drink and whatnot. So anyways, we'll have more information on that shortly. As always, we appreciate your guys' support. All we ask is that you share this episode with at least one friend, one family member, trying to continue to build the Looney Hour community. So, help us build that so we can, reach more people and, make change for the good. So as always, appreciate your guys' support. See you next week.